So I want to tell you guys, after we get done with this one, we'll look at some different time frame charts, and we'll go ahead and talk about how to enter and when to enter and how to kind of put the things together that I've done in the last 5 sessions or so to actually have a little bit of a strategy. Now, the thing I want to throw out there is this should not be the strategy you adopt and abandon your other strategy, right? If you're struggling with your strategy, I'm hoping that some of the things I've shown you over the last couple of sessions, over the last few sessions, you can integrate. And then possibly you end up adopting what we do, but there's a lot more to what we do than I can show you in these sessions. I mean, it would be like a 6-week course if I was going to show you everything. But this is a start where you guys can take these basics and say, okay, I'm going to throw this in and see how it looks. So yeah, so trade trend lines are trend lines that are drawn with 2 points, an entry, or I should say an initiating point and a defining point. Okay. And if you break that trade trend line, your first target is the defining point. Okay. So it's the point closest to recent price action that defines the angle of the trend line. Okay. And then your next one could be the initiating point of the trend line, or it may be a longer trend line that's in the way of you getting to the initiating point of the second trend line. So imagine that you have 2 trend lines and they sort of look like this, right? This one is longer. If you break this one, you get to the defining point and then you keep going, you're probably going to get to this trend line. And this trend line often matches the initiating point of the other trend line. All right. Trend lines that are drawn upward sloping from lows, those are trend lines. Trend lines that are drawn upward sloping from highs, those are targets. Those are not trend lines. All right. So those are sort of the basics of what we talked about with trade trend lines. All right. So you're going to be looking at trend lines differently if you rewatch that session once it makes it through TradeZero's compliance, because you're going to see trend lines differently. Now, today we're going to talk about rotation zones, where we talk about moving averages, and moving averages also show trends, but I'll discuss that in the presentation. All right, so moving averages showing the trend. Moving averages are lagging indicators and do not predict a new trend. That's very important, but can help confirm trends after the new trend has been established. A market is in an uptrend when the current price action is above a moving average and the slope of the average is sloping up. And a market is in a downtrend when the current price action is below the moving average and the slope of the average is sloping down. Okay, that seems obvious, but start looking at it that way. It is a combination of both these factors confirm that the market is in a trend. Since moving averages lag the current price action, it will take longer for the average to turn. So the confirmation of the moving average showing a trend change is not solely dependent on the price being above or below an average. So in other words, if you have a flat moving average, it's not telling you anything. It's telling you nothing. All right. A lot of people go, oh, the moving average is just crossed. But if they're flat, it doesn't mean anything. The more widely used moving averages like the 10, the 20, the 50, and the 200 generally provide the best support and resistance. Why? Because they're widely used. We believe this is due in part to a self-fulfilling prophecy theory, which is why the more popular moving averages routinely test out as providing the best support and resistance locations. But I don't really care about that. Support and resistance to me is easy, right? You can see it just by glancing at a chart. Too many traders treat the moving averages as an exact price for support or resistance. In reality, the moving averages should be treated as an area, okay? The price might overshoot or undershoot the moving average, all right? Like here's an example of a 20-period exponential moving average providing support and resistance to price action. I'm sorry, I didn't mean to move that. So you can see it provides it on the left here. It's providing support in the middle of the screen here, but it's breaking it constantly. And then as you move to the right, provides good support, provides good support, provides good support, breaks it again, but still provides support, right? These are areas, not absolute brick wall stop prices. So what is the R zone? Price does not travel in a straight line. I think if you don't know that by now, you're in the wrong business. It forms a series of waves or rotations. A lot of people look at Elliott wave because of that theory. Many times these rotations produce swings. The swings in turn produce chart patterns and trend lines. We call areas where rotations are likely to happen the R zone or the rotation zone. R stands for rotation in this context, okay? So here we have rotations forming between key moving averages. That's an R zone, okay? Each one of these arrows points to somewhere where the price moved into an area between two key moving averages and then held up. Now you're still seeing breaks, just like I talked about on that first slide that I showed. There's still breaks, but you're getting a zone instead of just a flat price. When you're using one moving average and saying, this is where it's going to stop, or worse yet, this is where I'm going to place my stop, you're going to be disappointed. The moving average R zone, okay? Pure price action can potentially set up in rotation zones. The last slide we just looked at was based on moving averages setting up rotation zones. In prior lessons, we've covered the concept of significant levels. We actually have in very, very early risk courses here where I talked about stop placement. So you may not have seen that. We consider some key moving averages to be dynamic significant levels. Significant levels as a term, the way Mike Arnold and I use it, is a price level. Moving averages, so it's what we call static, okay? Moving averages are dynamic significant levels. So we combine two moving averages to produce a zone or a space, and between these moving averages that expands and contracts with price action. At some point, the moving averages will cross and start to separate, producing a potential rotation zone. Notice that we said they have to cross and separate, not just cross. All right. Future price action will then pull back into that zone where it may find either support or resistance and resume the move back in its additional direction. This is where we can find trades. Moving averages are price areas. Some traders look at the moving averages and expect price to stop directly at the moving averages. These are traders that use moving averages as a stop area. They're likely to be disappointed because moving averages provide price areas where price can react. Similarly, as price does not stop exactly at a significant level, price does not have to stop exactly at a moving average. So what moving averages do we use to form an R zone? We use exponential moving averages instead of simple moving averages. Exponential moving averages are weighted so the most recent candlestick has a greater impact on the moving average than past candlesticks do, or prices, whichever way you want to call it. And we construct our rotation zone with the 8 period and the 21 period exponential moving average. Okay, why do we use exponentials? Because recent price action carries more weight than old price action. Markets have very short memories. Okay, they remember stuff in the past, but they much more aggressively remember stuff in the recent past. And exponential moving averages are weighted, so the most recent price action has a greater impact on the moving averages. So in our rotation zone, we use an 8 period and a 21 period. The other thing I'll mention with this slide is the word period is very important. Okay, it's very important because if you're looking at a 60-minute chart, you're looking at an 8 period, so 60 minutes of 8 moving averages, and a 21 period, 60-minute moving average. Okay, if you're looking at a daily, it's an 8-day exponential moving average and a 21-day exponential moving average, and so on. These are moving averages that match the period of the chart you're looking at or the time frame of the chart you're looking at. We also add in the 50-period EMA and the 200 SMA, the simple moving average. Why the 8 and the 21? Anybody asked that already, Badish? I assume they did.
Yes, in the previous sessions.
Yeah. Based upon our testing with the trend line entries, other technical patterns, and the concept of space, which I talked about last week, I'll show you guys space on a chart in the near future. The moving averages that perform the best are the 8 and the 21. It's really that simple. It tested out better. The exponential moving averages tested out better than the simple moving averages or the weighted moving averages. In addition, they fit perfectly in the Fibonacci sequence. Okay, so we didn't just pull those out of our rear ends and say, we'll try these out. We tested multiple types of exponential moving averages within the concept of trend lines in space. Why the 50? Well, the 50-period moving average is one of the most popular moving averages. And due to the sheer number of people watching it on their charts, we use the 50 instead of the 55-period moving average from the Fibonacci sequence. Okay, this is a case where the 50 EMA instead of the 50 simple MA tested out better. Okay, we don't just make things up. We've tested anywhere between 10 and 20 years of data. And by the way, this testing happened 10 years ago. Okay, so really it's about 30 years of data now instead of 20 years because we haven't changed them yet. Why the 200 simple? 200 period simple moving average is probably the most watched long-term moving average. This moving average, especially on a 60-minute chart and higher, provides a good area of potential support or resistance. We've tested the EMA versus the simple, and the simple has proven to be more significant in a 200 period testing environment. Okay, so again, we didn't just say, well, the 50 tested out better as an exponential. The 8 and the 21 tested out better as an exponential. So we'll just do the 200 EMA. No, we tested them, and the 200 SMA works better. And these form our dynamic significant levels. We consider the 8, the 21, and the 50s dynamic significant levels because of the same price action tendencies that form at the moving averages, just like at traditional significant levels. You get emotional candles, which are either big colored candles, red or green, or they have massive wicks. You get tails at or near these averages. The massive wicks that I just talked about happen at or near these averages more often than not. And candles seem to either run away or break through these averages aggressively. That's the testing we looked for. All right, so here's an example of the 8 and the 21 EMA R zone combined with a 50 in green and a 200 simple in red. And you could just glance at this and see the reactions. I want you to pay closest attention to the reaction of the rotation zone areas. For example, here in the sort of left middle of the chart, below the word, or I should say the letters SMA, you can see a dramatic break. But then you get price holding up at the 50, holding up at the 200, and rallying back. All right. All along the rest of this uptrend, you can see the rotation zone holding. And then it starts to flatten out at the top left. It crosses down. We don't trade the cross. All right. And now you can see it on the way back down reacting to basically the rotation zone, the 50, and then getting down to the 200 and reacting aggressively through it. This is real price action. It's not a chart that we created. This is real price action. Moving average rotation zones and time frames. Rotation zone on higher time frames are more significant than rotation zones on lower time frames. For example, the moving average rotation zone on the daily is more significant than the moving average rotation zone on the 4 hour, which is more significant than on the 60 minutes, etc. Now, trending price action and moving average rotation zones. The moving average rotation zones are significant when the market is trending. The stronger the trend, the more significant the rotation zone will be on shorter term charts. A very strong trending market might respect the rotation zone on the 5 or the 15-minute chart and not pull back enough to enter a rotation zone on a 60-minute chart. So when you're in these trends, you want to scalp in the direction of the trends, not the opposite direction. And you can use R zones on those shorter term charts for the same reason. Now, moving averages in congestion, when a market enters an extended period of consolidation or congestion, the moving averages will begin to converge and tend to go flat, centered around the middle of the congestion. When we see that happen, the rotation zone doesn't matter to us anymore because it doesn't exist. We ignore it and we wait for the market to get out of congestion. The easiest way to see this is when the market forms a horizontal channel price congestion. Another sign is that the market is in congestion or consolidation, and that the moving averages will also cross back and forth repeatedly. Look specifically to this area on the right. Moving averages converging and going flat in a horizontal channel. We don't pay attention here at all to the rotation zone. You can see it cross twice. Price action was just kind of back and forth, and the rotation zone existed in the middle of the price action. That's when we don't pay attention. Now, breaking out of congestion, you can see that they will start to separate. Price action will follow through with the breakout or breakdown from congestion. Then it's time to start watching for the moving average R zone to provide potential support and resistance. Just because price enters the R zone, it doesn't mean there is a trade. A valid trade setup and trigger still has to occur. Okay, I'm going to skip this one right here just to go here where I show you that we get across kind of in this area. The 50 EMA holds up. I'm in the middle of the chart right now where this congestion is. Then we break out of congestion. And here where you see this cluster of 3 arrows, you see that the R zone is providing support in a trending market. And that's when you get good trades. This is putting it all together. I'm going to stop here because we're running out of time, but you kind of see the same thing on this chart. This is a zoom in of that exact same chart where you see that the R zone is congesting, is in congestion. You could see it's going through the price action. Then it finally starts to widen and move in a trending direction. And that's when you can find trades. The reason I'm going to stop here and stop sharing is because I want to share one more thing with you guys before we run out of time. And we're already kind of over on our stop time, but we got about 5 minutes left in the session. So what you're looking for is for the R zone to go from a flat area to a wide area in either direction. In other words, it's widening and trending in a direction. And when you see that, you can now start looking for trades, whether it be in your strategy on a shorter term time frame, or whether it be in some of the entries that I've shown you in the past. Next week, I'm going to cover how to enter in a rotation zone. I'm not going to do a PowerPoint. I'm going to pull up the TradeZero platform, Zero Pro, and I'm going to find things there where I might actually see entries. If you remember, about 7 sessions back, we actually did that. I told you guys that this would be a rotation zone entry for me. And then 2 or 3 days later, it might have been the next day, I don't remember. I put out a tweet saying, hey, anyone who was on that TradeZero session, this trade was profitable, right? Because it showed it. Badish, I think you remember.
Yeah, it was a Bros. Was it Bros?
Yeah, it was Pros,
Yeah.
right.
Yeah.
Right. That's the stock it was. And that particular trade worked, which is Bros is it's a coffee stock, right? And that particular trade worked. Now, I didn't want to show you guys a live trade because I don't want you taking trades until you understand that the concept we're covering here is risk, not trade entry. Okay. But what I'm trying to get you guys to see is there is a way to look at the rotation zone and trend lines combined and say, okay, this is probably a lower risk trade. And when you get a lower risk trade, that doesn't mean you put on a larger position at all. Okay. That just means you've got a higher probability trade so you can manage your risk and you can feel better about it, as opposed to putting on every single trade you see with no process at all.
Thank you so much for that, Bob. I was going to ask, do you use supply and demand zones for entry points?
I don't, no. Although they may turn out to be supply and demand zones. So one of the things about technical analysis you'll notice is things line up. So for example, when the rotation zone crosses and moves higher or crosses and moves lower, I don't trade the cross. I love to trade the first test. All right. Now that doesn't mean that it goes in there and I buy it. Okay. I've talked about this before. It goes into the rotation zone and then I draw a trend line and I wait for it to break back out again. And once it breaks back out, I go with that. That's likely going to match up with supply and demand zones as well. Probably matches up because you're getting a pullback and a retest, and a lot of people will, a lot of like demand will come in those areas. But you have to have the breakout in the first place, which is likely a supply and demand zone as well. So Luke says, is this for day trading? Luke, I don't like to call you guys day traders because you could potentially get into a trade, exit it at the close, and the next morning you still see the same trade is still good. Okay. You put that back on, that's basically the same trade. So you're not really a day trader. You're a swing trader covering at night. So that's why I don't like to name you guys these things, right? But I will tell you this, Luke. If you pay attention to the R zone on a daily chart and then a 60-minute chart, and then you go down to a 5-minute or a 15-minute and trade in the direction of the daily R zone, you have a higher probability of success. You guys know the content I give you in these sessions is evergreen. And if you've never heard the term evergreen, that basically means it lives forever because that's what evergreen trees do. All right. So the content, you can look at this content a year and a half from now and it's still going to apply to markets. I don't give you guys, hey, this week we had CPI and you should trade this way. That's not what I do here. So no matter how old the session is, you're going to be able to use it.